Welcome to the FwP Financial Planning Sheets. If you're working with the free version, it's going to look a little bit different than what you see on the screen. What I'm working with here is the member version. The difference is that in the free version, you have 3 tabs at the bottom. In the member version, you have 6. If you've purchased a course or you're a member of the site, then you have access to this member version. But if you're using the free version, stick with me through the first 3 tabs. If you're using the member version, stick with me through all of the tabs. And then if you have the free version and you're curious as to what the others do, then finish watching this video. If you've watched the budgeting video, I talk about getting your entire month of transactions and highlighting all of the money that comes into and out of your account. That way you can track your income, you can track your need spending, your want spending, and your savings. I've already pre-filled this sheet for a month of transactions. Yes, they all happened on the first of the month, but I've pre-filled this sheet to make this go a little bit quicker. In row 9, the very first row of transactions, that's going to be your starting balance. Whatever your balance was in the account on day 1 of you tracking your spending, that's what goes into this cell. For this example, we're going with $500. Then, starting in row 10, you're going to put all of your transactions for the month. I know there are easier ways that you can go about doing this. There are apps that you can download that'll do this for you. But for the purpose of this exercise, you have to get ingrained with your money. You have to know where it's coming from and where it's going. That's the point of these sheets. There are a few things about this sheet that I want you to keep in mind. This sheet functions based off of the information that goes into your month of transactions. So accuracy is very important. That's why I'm making this video. All of the magic happens because of the number that's in column A. The number that's in column A comes from the date that you put in column B. Every transaction that you put into this sheet, make sure that it is dated. That way the math is being done correctly in the other sheets. Give every transaction a description. If you went out to eat, put where you went out to eat. If it's a paycheck, call it a paycheck. If it's your check, then put your name on it. If you're married and it's their check, put their name on it. But put a description just so you know what that money was either used for or why it was received. Column D, you're going to categorize everything. So if it's a paycheck, then it needs to be categorized as income. If it's an expense, then categorize it as the expense that it is. If it's your mortgage, then put it in as a mortgage. Now keep in mind, you may have some needs-based spending that I don't have a category for, and that's perfectly fine. You'll notice that in row 15 and then in row 22, I have miscellaneous spending for home and auto. This could be for oil changes, tire rotations, whatever the case is. If it's a needs-based spending and I don't have it listed in a category, then simply scroll down and hit Other Needs-Based Spending. That way, at least it's categorized appropriately. Anything that you put in column E should be income only. It should be money that comes into your account. Any money that leaves your account should go in column F. If you mix these up, then the math isn't going to math properly. So make sure that income is in your income column and expenses are in your debits column. All of your transactions that are considered miscellaneous spending, label them all as miscellaneous spending. If you go to a restaurant, miscellaneous spending. If it's for your hobbies, miscellaneous spending. Whenever you spend money and it's not a need and it's not for savings, then classify it as miscellaneous spending. And then if you have a situation where you're contributing into a Roth account every single month, then put that in there. You'll go to the category column, find your after-tax savings, and that's what you'll put it in as. The final thing that I want to go over about this sheet particularly is I don't want you to put in your debt payments outside of your mortgage. If you have a car loan that you make a payment on every month, don't put it in there. We're going to put it in another sheet. If you have a credit card payment or a student loan, any debt that you make payments on, don't enter that in this sheet yet. I know it's a little confusing. It'll make sense later. But make sure that every item that you put into this sheet is dated and dated correctly, has a description, make sure that it's categorized, make sure that money in is in column E, money out is in column F, and then don't do anything in column G except put in your starting balance. The second sheet that you're going to come to is your week of transactions. And I know what you're thinking, dude, we just did this for an entire month. And you're exactly right. If you're following the 8-week financial kickstart program, week 2 is all about conscious spending. The point of the month of transactions is just to get a baseline of where all of your money is going and where it's coming from. Week 2 is meant for you to consciously spend money. Because we don't use cash anymore and we just swipe cards for everything, we don't feel the pain of spending money. But knowing that you're going to categorize every single transaction for 1 week makes you a little bit more conscious about the money that you're spending. What I want you to do is I want you to date every transaction. I want you to give it a description. I want you to categorize it. And then I want you to put in how much money you spent. We're not worried about the money coming in. We've already been over that with the month of transactions. With the week of transactions, we want to know all of the money that's going out and why. Don't do anything to column F. Column F is going to calculate on its own. But there is another column, and this is your conscious spending column. The other thing that I want you to do with this sheet is anytime you think about spending money, like maybe you think about going out to eat and you decide not to, you stay at home and you cook dinner at home, I want you to input that into the conscious savings column. Just as an example, we'll say 1/1 of 2024, we'll call it McDonald's. We know that this would have been a miscellaneous spend, but since you didn't spend the money, we're not going to put anything in the debit column. Because you were making conscious decisions with your money, you decided not to go. Maybe you were able to save yourself $15. As you enter your conscious savings, it's going to total up here in the top for you. At the end of this week, I want you to have a value on your conscious spending. The lunches that you skipped out on, the dinners that you skipped out on and instead ate something at home or from home, I want you to annotate that. I want you to put a value on conscious spending. Who knows, maybe at the end of a week, you've saved $50 because you didn't spend the money that you normally would have spent. That $50 may not seem like a lot, but if you multiply that by 52, because this is a week of transaction and there's 52 weeks in a year, that's $2,600 that you've saved yourself simply by paying attention to the money that you're spending. During week 2 of the Kickstart program, do this sheet and see how much money you're able to not spend on things that you don't need. The final sheet of the free version, or the third sheet of the member version, there are a lot of moving pieces with this sheet, and I want you to pay close attention to how this sheet works. So the first thing that I want you to notice is there's a lot of yellow boxes on this page. Yellow boxes are good for you to enter information into. If it is not yellow, do not enter any information in that cell, or it could potentially mess up the sheet. So only enter information into the yellow boxes. The date, you don't have to put a date in there if you don't want to, but you can. For your net worth, you're going to put in whatever you have in savings. If it's $1,000, you put in $1,000. For checking, you're going to put in whatever you have in checking. So maybe you have $1,000 in checking. You put in $1,000. For liabilities, this is where you're going to list out your debt. There's a drop down that you can use, and if your debt isn't a credit card, an auto loan, or a student loan, then just classify it as other non-mortgage debt. What I want you to do is start with your lowest balance debt first. So if you have a $2,000 credit card, put that one first, if that's the lowest balance. This is going to come in handy later on when you build your debt payoff plan. I also want you to put in your minimum payment. Maybe on a $2,000 credit card, you only owe $75 a month. So you're going to put that in your minimum payment. Your interest rate, you can put that in there. You don't have to, because all debt repayment plans are going to be the snowball method anyway. So you don't necessarily care about the interest rate. But to give yourself a full overview of your debt situation, you could put your interest rates in there. What I want you to notice in column A and column B is that this information is going to start to update. So you put in a credit card and you put in the minimum payment of $75. This is why I don't want you to put debt on your month of transactions, because we're going to put that over here. But as you go down your debt, column A is going to change, as will the minimum payments. So put all of your debt here with the minimum payments, and that's going to finish out your spending. For your spending, you're going to see all of your income laid out, and this is the importance of categorizing. By categorizing everything on your month of transactions, that ensures that the information makes it to this sheet with no hiccups. So all of the income that we entered on the month of transactions is now reflected on this sheet. Total after-tax income in this example is $5,915. Everything that you categorized as a need is going to be totaled here. This number divided by your total after-tax income is what's going to give you this percent. In the budgeting video, I go over percentage-based budgeting, and my favorite is the 70-15-15 budgeting system. 70% of your spending is towards needs, 15% is towards savings, and then the final 15% is set towards your miscellaneous spending. If your needs-based spending is under 70%, then this box is going to be green. The cell underneath is going to tell you that you're good to go. If you're over 70%, this box is going to turn red, and then below it, it's going to tell you what you need to reduce it by. As long as you categorize your after-tax savings appropriately, that's going to total here as well. In the month of transaction sheet, we didn't put in an after-tax savings, so there's going to be a zero balance reflected. If that's the case, then that's perfectly fine. That's the point of this sheet, is for you to understand what your money is doing and where it's going. Because we're not hitting that 15% goal, this box is going to be red. Just below it, it's going to tell you what you need to increase your savings by to make it green. And then finally, all of your miscellaneous spending is going to be tallied. You're going to have the same percentage box over here. As you can see, it's red because it's more than 15%. To get this where we need it to be, we need to decrease this spending by $212. So the purpose of the financial dashboard is so that you know where you're overspending and where the changes need to occur. But you're only going to get accurate information if you put the information in correctly on the month of transactions. Under investment accounts, I want you to enter all of your investment accounts. So if you have a 401k, you're going to put that here. If you have a Roth IRA, you're going to put that here. I want you to put in the current value of those accounts. So if you have $25,000 in your 401k, put that in there. If you have $7,000 in your Roth IRA, put that there. And then for your monthly contribution, I want you to put in how much money is going into that account every single month. The Roth IRA is pretty straightforward. If you're putting money into a Roth IRA and say it's $200 a month, then you just put that in. If you're putting money into a 401k, you have to take into account your contribution plus your company match. If you get a 5% dollar for dollar match into your 401k, and you're putting in 5% of your salary to get that full match, then you're going to take your salary, you're going to multiply that by 5%. That's your contribution. You're going to add that same amount for your employer contribution. Take both of those figures, divide it by 12. That is your monthly contribution. So if you make $50,000 a year and you get a 5% dollar for dollar match, that's $416 per month going into your 401k. $208 from you, $208 from your employer. Based on how your company works, you're going to have to figure out what your monthly contribution is for your employer-sponsored account. Having this information correct is going to help you later on. What you'll notice under the net worth column is that these cells have started updating. Your $25,000 401k, your $7,000 Roth IRA are listed out in your assets. I put your mortgage, if you have one, as its own line item. Our focus on debt reduction is all non-mortgage related debt. The mortgage will be the last thing that we focus on. But if you have a mortgage, put in your current balance. Maybe you owe $250,000 on that house. You can put in your minimum payment. It's not going to affect column B, but just so you have all of your debt information in one area, you can put that minimum payment in there. Once you have entered all of this information, it's going to give you your liquid net worth. Now, if you're young or if you're just trying to get your financial life turned around, you may have a significantly negative net worth, and that's perfectly okay. We all have to start somewhere, but this is step number one. Understanding where your money comes from, understanding where your money goes, and understanding the liabilities that you're responsible for is how you can begin making smart financial decisions. If you're using the free version, this is the end of the road of the instructional video. If you're using the member version or you're interested in what these other sheets do, then stay tuned. If you've watched my video on an emergency fund, I go much more in depth into what I think an emergency fund should look like. We go over the basic emergency fund of having $1,000 per person in your household, but beyond that, deciding the level of your emergency fund is a little bit more involved based on your situation. There are 3 sections that you need to answer yes to one of them. So each section should have 1 yes and 1 no. If you're young, meaning you're less than 49 years old, then this answer is going to be yes. If you're in a stable and a high demand job, then you would enter yes. If you're in a steady and secure paying job, you would enter yes. Depending on your answers, your income multiple is going to change. So let's say you were older than 50. We would change this to yes. That income multiple changed to 6. This is going to tell you what your true emergency fund should look like. It's going to take into account what you currently have in savings. It doesn't take into account what's in checking because we know that money ebbs and flows. But the money that's actually set aside for your emergency fund, you have $1,000 in savings. This means that you have a deficit of $34,490. Once you have your basic emergency fund, once you've received your full company match and you've maxed out your Roth IRA, you may want to look back to your emergency fund to make sure you have enough cash set aside to get you through any rough patches. But the point of this sheet is to help you calculate what your true emergency fund is. Sheet number 5 is the life insurance estimator. And what this is going to tell you is the amount of life insurance that you should at least consider having. Whole life insurance, everyone should have a small whole life policy simply to take care of your body the way that you would wish once you pass away. The rest of your life insurance coverage needs, you should look into term. The first option is have enough term life insurance to pay off your debt. You could also add in any future expenses that you would want to cover. So if you're 30 years old and you have a child that's not yet an adult, you want to make sure that all of the debt is going to be paid off if you pass away, but you may also want to cover your child's college education. If that's the case and you anticipate that being maybe $100,000, then you would enter the $100,000 into the cost of future expenses. Your debt is already going to be calculated from the dashboard. So don't do anything with the debt. The debt is calculated based on what you have already put in the sheets. But those future expenses that you may want to cover, you're going to want to enter those into the yellow box. The sheet simply adds up those two numbers, and your total term that's required to pay off your debt as well as cover any future financial expenses is going to be $357,000. In a lot of cases, this is going to be the more budget-friendly option. If you have the room in your budget to replace your income, then you could look into the third option. The point of replacing income is to replace the net money that your family receives from your paycheck. The sheet is going to pull in what your net income is. So that's the importance of making sure that the income goes in the income columns and the debts go in the debts columns of the month of transactions. That information is feeding the dashboard, the emergency fund estimator, and the life insurance estimator. So make sure that information is as accurate as you can possibly get it. But using this option, you're going to determine how many years of income you would want to ensure your family has in the event you pass away. If you're 30 and you just had a child, then maybe you only need 20 years of term. That way, if you pass away, your net salary continues to come in until that child is an adult. So you could change this. Maybe you need 20 for yourself, 20 for a spouse. You need $710,000 of term life insurance coverage on each of you. But you could change these numbers to whatever you would like it to be. The final sheet that you have access to is the income replacement estimator. What this is designed to do is to tell you how much additional you need to save each month to replace either 70% of your income once you retire or 50% of your income once you retire. 70% is meant for those that are going to be carrying debt into retirement. Replacing 50% is meant for those that are going to be debt-free as they get into retirement. This worksheet is meant to help you calculate what that number is. Just like all the other sheets, anything in yellow is where you input information. So we'll assume this married couple makes $100,000 per year now. They anticipate a 3% raise or average inflation. Their current age, we'll assume they're 30, and they have a target retirement age of 65. Their total salary at retirement would be $281,386. They could input a Social Security benefit here. They could also input a pension benefit for each of them, but this section is mostly designed for those that are within 5 years of retirement because the numbers you enter are going to be a little bit more accurate than someone who is 30 years away. So you can use this section if you're in your accumulator stage, but if you're within 5 years of retirement, this section itself is meant more for you. We'll see here that their current invested savings is $64,000 and that they're contributing $1,232 a month. Where does that information come from? That information comes from the financial dashboard, and most specifically in the investment account sections. Now, I know earlier in the video, I only had the one Roth and the one 401k. I went ahead and doubled that just to show you how this sheet works. But having the monthly contributions put in correctly is very important on this sheet. Your contribution plus anything your company puts in has to be accounted for if you have a 401k. Depending on what amount of their income they would like to replace in retirement, the estimator is going to give them what their annual income would be, or $196,970. It's also going to tell them that you need almost $5 million to replace 70% of your income, assuming a 4% withdrawal rate. Depending on the rate of return that they plan on receiving, this is going to tell them how much they need to add to their monthly savings to hit that goal. Even at an 8% rate of return, they're still going to need to find $700 additional each month to hit the $5 million goal. If you're looking at this when you're age 30 and you think, there's no way that I can find another $700 in my budget, then you need to start planning to replace 50% of your final salary. If you replace 50% of the final salary, the amount that you need at retirement is just over $3.5 million. At the same 8% rate of return, you need to find $11.38 per month to add to your savings. That's much more doable than trying to find $700 a month, especially at age 30 if you've added a child or two to the situation, you've upgraded your house, you have nicer vehicles or maybe newer vehicles because of the children. But knowing these numbers is what's going to put you on the right path to hit your retirement goal. If you've made it all this way, you're either a member or you're at least considering becoming a member. All I can say is thank you. Thank you for taking the time to look through this stuff, even if you never use it. The fact that you took time out of your day to look into what I have to offer, I greatly appreciate it. I hope that these sheets can bring some value to you, whether it's the organization of the free version or the more in-depth look at your numbers when it comes to the member version. I appreciate you looking at this.